Welcome to this explainer. If you are managing finances, reviewing balance sheets, or just trying to figure out how a business keeps its books tied to reality, you're in exactly the right spot. Today, we're unpacking IAS 36. That's the international accounting standard dedicated entirely to the impairment of assets. Think of it like a medical health check, but for your balance sheet. Here is our agenda. We've got 5 main steps today. What is asset impairment? Identifying the warning signs, calculating the recoverable amount, understanding cash-generating units, and finally, the rules for impairment reversal. Let's jump right in. So picture this for a second. What actually happens to your books when a $1 million asset just suddenly loses its value? Let's say market conditions crash or a massive vital piece of machinery completely breaks down. This is the exact core problem every business manager and accountant faces, and it's exactly the scenario IAS 36 is designed to solve. Because, accounting isn't just about recording what you paid for something 10 years ago. It's about accurately reflecting what that asset is actually worth to your business today.
Let's start with Section 1. What is asset impairment? We really need to define the baseline issue here.
Okay, the golden rule here is that a company absolutely cannot carry an asset on its books for more than it's actually worth. An impairment loss happens when the carrying value of an asset, so the amount currently recorded on your balance sheet, is higher than its recoverable amount. If your books say a machine is worth $500,000, but its true recoverable amount has plummeted down to $300,000, well, you've got an impairment loss of $200,000. You literally have to write it down. It's a fundamental principle of prudence. We never want to overstate how healthy a business really is. But before we start testing everything in sight, we have to rule out some specific items. IAS 36 just doesn't apply to everything. Inventory, that falls under IAS 2. Financial assets are governed by IFRS 9. Deferred tax, employee benefits, assets held for sale, they all have their own highly specific accounting rules. IAS 36 is really targeting your standard property, plant, and equipment and intangibles. So if your asset is on this list of exceptions, you're going to need a completely different standard. Moving on to Section 2, identifying the warning signs. How do we actually spot the symptoms of asset sickness? We aren't just blindly testing assets every single day, right? We look for specific triggers. Look inside your own company right now. Has a machine been physically damaged? Or maybe look outside. Is the broader market shifting against your division? The standard divides warning signs into 2 distinct buckets, external and internal. Think of external indications as things happening out in the world. Have interest rates suddenly shot up? Has the asset's market value dropped out of nowhere? Are there huge adverse shifts in the economy, politics, or technology? Or maybe your company's overall market cap has dropped below its book value. Those are massive external red flags. On the flip side, internal indications happen in-house. Physical damage to a delivery truck, performance reports showing an asset is lagging, or maybe a decision to completely restructure an operation. If any of these symptoms pop up at your reporting date, boom, an impairment test is immediately triggered. Now, there are a few exceptions where you don't wait for a warning sign. While most assets only need testing when those symptoms appear, there are 3 specific types of assets that require a mandatory, routine checkup every single year, regardless of how healthy they look. We're talking about purchased goodwill, internally generated intangibles that are still under development, and intangible assets with an indefinite useful life. Since these don't have a predictable wear and tear schedule, like a physical truck or a factory might, the standard demands we test them annually to make absolutely sure they aren't silently bleeding value. All right, Section 3, calculating the recoverable amount. We've spotted the symptoms, so now it's time to get the diagnosis and find out exactly how much value has been lost. What's really fascinating about this process is how we actually determine value. We compare what we could sell the asset for today against what it will generate if we just keep using it. The recoverable amount is always the higher of those 2 numbers. Option A is the net selling price. Essentially, it's fair value minus whatever it would cost you to sell it right now. Option B is value in use, or VIU, which is a bit trickier. VIU is the present value of the net future cash flows you expect to get from continuously using the asset and eventually disposing of it. You have to forecast this using a pre-tax, risk-adjusted discount rate, and you usually cap those cash flow projections at a 5-year maximum. Oh, and you have to ignore future finance costs or any future capital expenditures that would upgrade the asset. You judge the asset exactly as it sits right now. Whichever number is bigger, selling it or using it, that becomes your recoverable amount. But let's be real, data gets messy in the real world.
What happens when you just don't have all the numbers? This matrix is kind of like your quick reference cheat sheet. If you have both the value in use and the fair value, awesome, just take the higher of the two. But what if there isn't an active market to sell the thing? Then you only have value in use, and that becomes your recoverable amount. And if you only have fair value because you can't accurately predict the cash flows of that specific asset alone, maybe because it doesn't work by itself, then you actually can't test it individually. You have to step up and apply the test to a larger cash-generating unit, which we'll define in just a second. Wait, before we do that, let's talk about the actual accounting entry. Once you've done the math and confirmed, yep, the carrying value is higher than the recoverable amount, you have to formally record the diagnosis. You debit impairment loss. If you're on the standard cost model, this hit goes straight to your profit and loss statement. If you use the revaluation model, it's treated as a revaluation loss against your existing surplus first. Then you credit accumulated impairment loss against the asset. Your books now reflect reality.
Okay, Section 4, Cash Generating Units Explained. Like I just hinted at, sometimes we just can't measure the health of a single asset in isolation. Enter the Cash Generating Unit, or CGU. The definition here is absolutely key. It's the smallest combination of assets that can generate cash flow independently from the rest of the business. Think about a labeling machine in a massive bottling plant. It doesn't make any money sitting there by itself. It only makes money when it works with the filler, the capper, and the conveyor belt, so you can't figure out its value in use alone. You have to expand your test to the smallest viable group of assets that actually produce an independent cash flow. In this case, the entire bottling assembly line. That whole line becomes your CGU, and you test the carrying value of the entire unit against its collective recoverable amount. When you start dealing with complex parent and subsidiary structures, the logic shifts a bit, especially when Goodwill gets involved. For a parent company, you just look at net assets. But down at the subsidiary level, you have to add in the Goodwill. And if you only own a portion and use proportionate Goodwill, you actually have to gross it up to 100% just for this test. I know, it's complex and takes a second to process, but it is absolutely vital for getting an accurate reading. Then, you compare that total carrying amount against the recoverable value. Now, if your CGU does take an impairment loss, you don't just spread that loss around randomly. You have to follow a strict 3-step hierarchy. Step 1, if there's an obviously impaired asset, like a piece of equipment that is completely totaled, you write that down first. Step 2, you wipe out the Goodwill. Goodwill always takes the hit early because it's the most intangible and subjective asset. Step 3, if there's still a loss left over to distribute, you allocate it to all the other assets in the CGU on a pro rata basis using their carrying values. But there is a massive rule to remember here. You can never reduce an individual asset's carrying amount below its fair value less cost to sell, its value in use, or zero. It's a hard floor to stop you from pushing an asset into negative territory. Finally, Section 5, Rules for Impairment Reversal. Let's talk about the recovery phase, because occasionally an asset regains its health. So, can we actually reverse an impairment? Yes, we can, but with intense scrutiny. Just like recording the initial loss, your accounting model dictates how you record the recovery. If you're on the cost model, the reversal is credited to your profit and loss, which gives your current earnings a nice boost. Under the revaluation model, it's treated as a revaluation gain and goes straight to other comprehensive income. But hold on, you have to be incredibly careful with the limitations here. The standard is super strict on reversals, and you really need to understand these limitations. First up, Goodwill. A write-down of Goodwill is fatal. You can absolutely never reverse it under any circumstances. Once it's impaired, it is gone forever. Second, you can't recognize a reversal simply because the time value of money has shifted, what the standard calls the unwinding of interest. And third, the cap. Reversals are strictly capped. You can't magically value the asset higher than it would have been if the impairment had never happened in the first place. You can only reverse up to the asset's original carrying amount, minus the depreciation that would have been charged if it stayed healthy. You're effectively just putting the asset right back where it would have naturally been on its depreciation timeline. So, as we wrap up this explainer, I'll leave you with a question to really think about. Are your books merely recording comfortable history, or are they brave enough to reflect current, messy reality? IAS 36 forces us to confront bad news quickly, it makes us group assets logically when needed, and it totally prevents us from inflating our recoveries. Keep these diagnostic rules close by. After all, if you don't know the true health of your assets today, how can you possibly plan for tomorrow? Thanks so much for joining me on this deep dive.